Hello friends, hope you guys are doing great. You are safe, healthy and strong. In this video, we are going to discuss about the tax return Schedule B. In the Schedule B, we are going to discuss about the interest income and dividend income, right? We know that when borrower is going to earn an interest income or dividend income whenever they will have funds in their bank, right? Like if I have 500,000 in my bank every year, I will definitely earn some interest, right? Whenever that interest is going to be more than $1,500, I need to disclose that those I need to disclose those funds as an interest income in my tax return, means Schedule B, right? It could be dividend income or interest income. Whenever it is my total earnings from are going to be more than $1,500, only then I'm going to disclose it as a taxable income. Otherwise, we will go through the tax return. If it's less than $1,500, it is going to be like, it could be non-taxable income, and I can just disclose all this income in the first page as a non-taxable income, and I can carry on. In those scenarios, as an underwriter, we might ignore this income, and that is how we do it most of the time, right? But there are few scenarios, there could be few loans where we are going to receive interest income or dividends. It will be disclosed on the Schedule B, and we have to review the Schedule B. You must be wondering what is the challenge there, right? To calculate the income, interest income or dividend income from Schedule B, it seems very simple, but believe me, it is not going to be as simple. Whenever as an underwriter we use this income, there are few scenarios which we always need to keep in mind, right? We need to review certain documents, and we need to make sure that this income, interest income, we should be continued for next, at least for next 3 years. Then only we can use that. We already know that is the thumb rule, right? Any income that we are going to use from tax return or from the source like bank or interest income or dividend income, we always need to make sure these income, right, should continue for next 3 years, right? So definitely we are going to look in the history. We will see the 2 years history, whether in the previous 2 years if borrower have received dividend income, interest income, then we are going to use that income in our for the loan qualification purpose. But other than this 2 years history, we also going to check the future continuance. How to check the future continuance, especially for interest? And there are going to be few scenarios which every underwriter have to have that knowledge. That is, even we could see borrower has enough funds in the bank, right, and he might receive the income or this income, this interest income or dividend income for the next 3 years. Still we won't be able to consider this income for the loan qualification purpose. We are going to discuss everything, all the scenarios, when we need to consider, when we need not to consider such income. But before that, I just wanted to share, if you haven't subscribed to this channel, please subscribe and share it with your friends, whoever who doesn't know about this channel. It is always a good information to be shared with your colleagues, with your friends. And if any one of you is interested to learn the underwriting, right, we are going to start our new batch in the in the coming month, that is in October. So people who missed in the previous batch that was started in August, right, there were many candidates who were not able to enroll themselves. Please feel free to enroll in the upcoming batch that is going to start in October. We are going to cover the basic fundamentals of underwriting and fundamental of mortgage. We are going to cover all 4 C's plus more C's, and we are also going to cover the manual underwriting, right? How to do manually, how to add conditions, what are the conditions, right? And how to conclude the entire loan. So all these things are going to take at least 3 to 4 months to get complete. So feel free to get enrolled in the upcoming batch. People who are new to this industry, who doesn't know more about the industry, wanted to get basic knowledge of mortgage, feel free to subscribe to www.indigenousoutlook.com. There I have created all my basic curriculum. Please go and www.indigenousoutlook.com, and you will see all the basic fundamentals of mortgage trainings are available there. Those are totally free of cost for you, right? I wish you all the very best, and go through those videos, learn as much as you can learn, and find a job, get a job. And then when you get enough knowledge, come to us and learn the underwriting as well, right? So let's start with today's session. Individual or personal tax return, right? Personal individual tax return form number 1040, correct? Now form number 1040 have different schedule. कौन से होते हैं schedule? Schedule A, B, C, D, E, F, right? F means farm income, right? A means, now let's see how they look like. So this is what our form is. Right, 1047 individual income tax return, right? This we have already covered. So these are the mainly two pages, right? Then schedule A. Schedule B won't be required in 99% of cases, right? It shows medical and dental expenses, taxes you paid, unless you are going to review any kind of taxes, right? Then only you need to go through. But since we are not looking at taxes, so in residential, we won't be requiring all this. Interest you paid, again, we won't be doing this, right? Gifts, clarity, casualty, so nothing. Almost schedule A. If someone asks you, you can tell it's the deduction. How many deductions? Like we are trying to, when we pay taxes, there are a lot of deductions that we apply, like 80 C, 80 A, B, C. There are different deductions. Similar kind of deductions which have been applied by borrower to save taxes, right? That is what it. All those deductions have been itemized on this page, bifurcated. So not for us. For residential mortgage, no, we need not to see at this form. Schedule B, as I told here, Schedule B is the form that will be considered or reviewed for whenever borrower is using interest income. Borrower telling I receive this income continuously every year, and I want to use this income for my loan qualification. In that case, obviously we will need Schedule B. And for if someone is telling that he or she wanted to use their dividend income, then it will also be found on the Schedule B. So this is the Schedule B. First part, there are two parts, right? In the first part, it will be interest income. Okay, so here they are going to write whatever, let's say VOA Bank. So there they have the interest, they received $500, and they might have some Stanley Bank, right? Stanley Bank. So from there they received 1,000. Different bank, they can receive the interest, and the total will be here, right? Whatever the total is going to be here. So you can review, right? Now, why I'm trying to share it with you, I'm giving you an example, okay? Let's say someone is telling that he is receiving interest income of $3,000, right? Or let's say $12,000 on an yearly basis, because in the tax return you will see whatever the amount written, that is the annual return, annual income, right? So they are telling they received from BOA Bank interest 12,000 in 2019 and 3,000 in 2018. So if we have to apply this as an income in the loan, then what we need to do, we will divide it by 12, and that is going to be 1,000 monthly income. Is that correct? Now, to verify this, you will go to Schedule B and you will see, okay, BOA Bank has actually got 12,000. Yes, it has. Let's say they have only BOA Bank interest income, and that is 12,000. Done. So total is 12,000. Now, you verified, yes, 12,000 is interest income, right? So you will take this 12,000, divide by 12, and 1,000 is going to be your monthly income. Now you can use this 1,000 as your income in the loan. Whatever other incomes, you can add this 1,000 as interest income. Is that clear? How to verify from tax return? In Schedule B, you will verify this. Now, when it comes to underwriting, the real twist is here. Whenever we are going to use the interest income, we used it, we are good. But the second most important thing, we will go to BOA Bank statement. Okay, and why I'm telling this? Because we will go to BOA Bank statement and we'll see, right, whether he has enough funds available there, right, that he will receive this income in the coming to the next 3 years. What I told you, whenever we are going to see in the past, we will see the 2 years history. So that is why we are checking 2019. Let's say we are in 2020, right? And so we are checking 2019 and 18 tax returns. There we can find borrower received 12,000 consecutive incomes. Or we can say, let's say borrower received income of 12,000 in 2022 and 2021. Both tax returns showing 12,000 annual income. So we are considering it as 1,000 per month because we verified from the past that borrower used to receive. But now we also need to look further, look in the future. And whenever we see the future, how many months we need to verify? 36 months.
Yes, sir.
Right? Borrower should receive, or this income should continue at least for the next 3 years or 36 months. That is what we are going to, that is how we are going to verify the continuance of any income. Right? That is what I do. Now, what we are going to cross-check, it is fine that borrower received 12,000 in the past 2 years as per the tax return. So we are good. But we also need to see the future, whether this income will continue for the next 3 years. So we will go back and we'll check the balance on the BOA Bank statement, where from whatever bank this income has been received, right? Whatever the bank, or from like BOA Bank, we will go and see whatever the income received, is there enough sufficient funds available so that this income continues for next 3 years. That is something we always need to check. Make sense? Now, the second, it is fine that obviously borrower has received and they are telling that it will continue. So obviously there will be amount. Let's say there is, we can see there is $100,000. Those are available, or 200,000 that those are available in the borrower's BOA Bank statement. Okay. Now, we know that this 2,000 is coming for the, is since last 4 years. It is continuing. So obviously, if last year borrower has received 12,000, at least this year borrower will again receive 12,000, right? And next year borrower will again receive 12,000 because that is the funds available. in the bank account. But what we need to be careful about as an underwriter, what we need to careful about, we need to see is, does borrower use any of the fund, right? Or is borrower using any of the funds from this account towards closing? So let's say borrower, what I'm trying to say, let's say borrower is purchasing a property. Borrower is purchasing a property of 400,000. This is the purchase price. Borrower is getting loan of 250,000. Then, or maybe by 250, borrower is receiving, let's say, 300,000 loan amount. So borrower need to pay down payment of 100,000. So if any borrower is gonna pay 100,000 down payment, obviously what we need to check whether this borrower has 100,000 available in his account. Once we will verify it, right, then only we are going to approve the loan. In that case, what going to happen? We will ask for the bank statement. Now borrower has given us this bank statement. Here I have $200,000. I will pay 100,000 from this account toward the down payment. Now, do you see what is going to happen in the future? What we were checking? We were checking that this income, 1,000 income should continue for the next 36 months. But this 1,000 or 12,000 was the income earned by this 200,000. Now, once borrower is going to purchase this property, he is going to withdraw 100,000 out of this account. What will happen? His balance will decline. His balance is going to will remain as 100,000 only. So if he was receiving 12,000 interest from 200,000 in the entire year, will he be receiving the same amount next year? Will he be receiving the same interest income from 100,000? No. So that is what the twist. We always need to be very careful when we do underwriting. Whenever we use interest income, we always need to check whether he has sufficient balance in the account that can generate similar type of interest for the next 2 years or next 3 years. First thing. But the second we need to be careful about, is there any circumstance, is there any chance that borrower is going to use this, amount, any amount, or she's going to withdraw any amount from this account? If that is going to happen, in that case, we cannot utilize this income, because we know this income will not continue, because borrower is going to withdraw funds out of this account. So if funds are not there, they will not generate money, right? Or it is going to generate lesser money. Does that make sense? Yes. As an underwriter, many people make this mistake. They consider the income. They also, consider the amount toward the closing, which cannot go together, right? So we need to be very careful. Whenever Schedule B interest income comes into the picture, you need to careful about these two terms, these two conditions. The number one, you need to make sure borrower has sufficient funds which can generate this much of income for next 3 years. The second, we always need to be careful that there should not be any funds that should be, borrower should not withdraw any funds from this account. If there is any chance to withdraw funds from this account towards closing or for any other means, then we cannot consider this income, this interest income from this account. Is that clear?
Yes, sir.
Okay, so for more information on the interest and dividend income, please feel free to go to Enemy Selling Guide. There you will find the clear-cut guidelines, right? What we have discussed so far. So, like when it comes to documentation, we need 2 years of signed federal income tax returns or copy of the account statements, right? And how we are going to utilize, how we are going to review, that we have already discussed about all these documents, right? Also, as it states, subtract any assets used for down payment or closing costs from the borrower's total assets before calculating expected future interest or dividend income. So if, like in our scenario, there were 200,000, 100,000 were, were withdrawn from the account, and those were paid as a down payment. So in that case, we are going to we have to look into what would the interest borrower is going to get next year, right? From the remaining balance in the bank statement, and accordingly we can utilize that amount in our loan for the qualification purpose. I'm very much sure this has been clarified to you. So as an underwriter, such information are going to be very crucial, going to be very important, and every underwriter have to have this kind of information, right? To make a sound decision on your loan. Thank you. We'll see you in next video. Till then, bye bye. Take care.